How long do you think it'll take for this economy to see some signs of recovery?
The beginning of the turnaround, if we have an effective and large enough stimulus, may come towards the end of the year. But we should be psychologically prepared for the notion that this time next year things will be worse than they are now, because it will take us months to get ourselves out of the problem. The foundations of the American economy for the last 5 years have been false foundations. Mm-hmm. It was a housing bubble, a consumption boom that was fed through the housing bubble. Now that that is done,
what's left?
What is going to keep our American economy going? That is the big question.
What will?
Well, I think that we will need a larger role for government. I think there are actually some fundamental reforms that have to go on and that will eventually, I hope, get onto the agenda. Just to give you one example of how bad the structure of our economy got. 30 to 40% of corporate profits were in the financial sector. A lot of people boasted of that. Mm-hmm. That's a sign of a sick economy, because financial transactions are a means to an end.
Because you're not actually creating anything. You're creating a financial product, but it's not an actual tangible
and
thing.
It's not what you gives you pleasure in any sense of the term. It's a means to an end. So we should have been saying, look at the size of our financial sector. We really got it down. That's a sign of an efficient financial system. But instead, we were boasting how big our financial sector was going.
What does today's unemployment rate tell you about the overall economy right now?
It tells us that our economy is very sick. It's the numbers themselves say that it's the worst in a quarter century, but you really have to look at where we're going. Even in the the recession in the began at the beginning of the 1980s, which was the deepest downturn since the Great Depression, there was not the kind of anxiety that there is today. Now, there were some problems. I don't want to underestimate some of the problems, but this is totally different. There is, as people keep saying, we are in uncharted territory. And so there is no confidence about how far we will go. We know that monetary policy is relatively ineffective. Interest rates can't go any lower than they're going. So we know that some of the instruments that have proven effective in the past are not going to be working today.
So how do we get out of this downturn?
We have to have a large and well-designed stimulus. And the current stimulus, unfortunately, is not well-designed. It has too much tax cuts, which we know are not likely to be as effective as we need. Americans will be saving more. Good for the long run. But we're not in the long run. We're in the short run right now. And in the short run, that is depressing our economy.
Do you see the real estate market continuing to suffer as we go out into the next year and the following year?
Well, what is clear is that we had a bubble. Housing prices are declining. Most experts think that we're only maybe 2/3, maybe a halfway through the full adjustment if we don't overshoot. The real disappointment to me is that so far nothing has been done to address the bleeding. In a way, what was so sad about TARP, the program of giving money to the banks, was that it was like a massive blood transfusion to a patient that was hemorrhaging without doing anything about the hemorrhaging. And while we were pouring money in to the banks, they were pouring money out in the form of dividends, in the form of bonuses, acquisitions of other healthy banks. And so we didn't even resuscitate the financial system.
What can you do to fix the banks at this point other than just keep throwing money at them?
You can't keep throwing money at them. And you have to realize, first, that there's this distribution issue between us and the banks. And the second one is a conflict of interest issue. that what we are now officially, are in effect the owners of the bank. We put in most of the capital, but we have no control. So their incentives, the incentives of those who control the bank, are not aligned with the owners, which in effect are the taxpayers. In economics, basic principle, incentives matter. And if your incentives are not aligned with the sources of the money, it's an invitation for a problem.
Would you let the banks simply fail?
No. The issue here is not whether banks are going to fail. The issue here is a principle of financial reorganization. And the important point is, as over and over again we fail, it destroys confidence. When they said $700 billion is going to fix the system, I knew, a lot of other experts knew, the way they were doing it wasn't going to fix the system. And we knew that was going to mean, at the end of the day, confidence would be eroded.
Just a lot of Band-Aids?
A lot of Band-Aids, and not enough thought about how do we use the scarce resources of our taxpayers.
How would you rank the current economic crisis on a historical basis?
Well, so far, this is second to the Great Depression. But in one way, this is much worse, or at least much more complex. That in the Great Depression, for the most part, the banks were involved in simple banking. They made loans. We knew what it meant for the firms or the households not to be able to pay back the loans, the mortgages to go in default. We knew how to straighten things out. It was not easy, but we did it. This time, our financial markets are interwoven around the whole globe. We have these complex credit default swaps, gambles that make this much more complex. The banks themselves can't value their own assets. And that makes figuring out what to do so much more difficult.
So what does it tell you as an economist? If you're to look forward over the next 5 years, are we in a situation where we could see a repeat of the 1930s?
Well, it won't be a repeat because the structure of our economy is different today than it was then. Though there is one similarity that hasn't gotten as much attention as it should. Then we were moving from an agricultural economy into a manufacturing economy. Now we're moving out of manufacturing into a service economy. And this structural change is a fundamental subtext of some of the problems that we're facing. The fact that it's a service sector economy means that the unemployment rate may not go up as high because there'll be more people working part-time. Already, if you go around to people in the service sector, as I do, taxi cab drivers, you ask them what's happening to their income. They say it's down 20, 30, 40%. They're not unemployed.
But they're making less money.
But they're making much less money. They're suffering. So these are people who are not in the unemployment statistics, but whose life is being very badly affected. The statistics on those who are involuntarily working part-time have soared in the last year. So we have a really serious social problem on our hands. That combined with the foreclosures, millions of poor Americans are not only losing their homes, they're losing their life savings with their homes. So I think we ought to begin to grasp the nature of the social problem that we are facing. And so yes, we have some of the protections that we put in place in the Great Depression to provide a buffer: unemployment insurance, food stamps, a welfare program. But we should be aware that in the United States, these are the safety net is one of the worst in the advanced industrial countries. So we are really not equipped to handle the kind of downturn that we very likely may be facing.